Hi, good afternoon, everyone, and thank you for attending our market outlook for 2023. So at this point, I'd like to start my fundamental analysis outlook on the market. So let me just share my screen. Okay. So anyway, I'm sure you are quite familiar how our market has performed strongly after bottoming out at the 5,700 level for this year. I think we're up close to 10% already, and we haven't even finished the month of January. So it just goes to show how strong the market is. And, you know, the good news is there are compelling reasons why our market is up. So first is inflation is on the way down. So I remember during the mid-year market outlook last year, I already shared with you that there are signs that inflation is on the way down. And I shared these two charts, the chart of oil and the chart of the CRB index. So commodities have continued to go down, and now it is well accepted that commodity prices are going down. But aside from that, we know that, you know, the second half of 2022 was very volatile because the Fed still said, well, we're not sure if inflation is really on the way down because goods inflation is going down, but we still have services and housing prices in the US, which are still going up. But then, you know, fast forward to today, we're also seeing signs that services are going down, the inflation in services going down in the US. And of course, the housing prices in the US are going down. So, you know, it's still up, by the way. It's still up by 12.4%. But that said, you know, the increase has decelerated. And if you look at the prices of housing, they're actually going down on a month-on-month basis. And, you know, this has led to the peaking of inflation in the US. So as you can see, the orange line, which is CPI, it is down, and it has been down for several months already. And the core inflation in the US, which is the PCE, is actually also going down. So almost all the concerns that the Fed have raised, which is why it continued to raise rates by 75 basis points, 50 basis points last year, are being addressed, you know. So, you know, because of that, even though the Fed is still very hawkish and saying that, oh, we're gonna continue to be raising rates next year, and we're gonna pause it, as implied by the orange dot here, the market does not believe the Fed. So as you can see, this the gray line is what the market is implying. So the market does not expect the Fed to, you know, raise rates all the way to the 5% level next year and then keep it on hold. Instead, it expects the Fed to maybe increase interest rates by 2 or 3 times, and then after that, cut in the second half, and then continue to cut. So that is what the market is expecting. And because of that, the market here in the Philippines also expects our own BSP to cut rates. Remember that one of the reasons why the BSP is raising rates is because it wants to maintain a comfortable buffer or spread between the peso interest rate and the dollar interest rate. So it said it's just following the interest rate hikes of the Fed point for point so that it can maintain a 100 basis point spread. Okay. And because of this expectation that the Fed will be more dovish this 2023 because of the increasing signs that inflation has peaked, the bond market is your forward indicator. And as you can see in the US, the 10-year bond rate after peaking close to 4.5% is now down to 3.5%. As far as the peso interest rate is concerned, we peaked close to 7.5% for the 10-year bond, and we're now at 6.2% as of the time of this writing. But I think as of today, we're actually below 6% already. And of course, because interest rates in the US are expected to go down, the dollar has weakened. And as we have discussed in our other market briefings, you know, the weakness of the peso is largely due to the strengthening of the dollar. And because of that, that is one of the major reasons why, you know, our peso did not reach senior citizen level last year, notwithstanding the concerns of the Filipinos. And we're now back to below 55. Thanks largely to the US dollar and expectations that interest rates in the US would go down. Okay, so the dollar has normalized. Okay, and aside from all of that, you know, this is all expected to happen without the US suffering from a hard landing. So that is what the market is saying. So I went to Bloomberg to look for the consensus economic forecast on the US. And as you can see, for 2023, the consensus forecast is for GDP to just slow down, okay, not to go into a recession, to still grow by 0.5%. And, you know, in the view of investors, the Fed has been successful in controlling inflation. So, of course, inflation won't just go down steeply, but at least, you know, from a peak of 8% in 2022, it's expected to go down to 3.8%. And core PCE, of course, also going down. There may be a slight increase in unemployment, but not to the point that it would actually lead to a contraction in the GDP. And as you can see here, the central bank rate, the consensus forecast is 4.8%, which implies a, you know, a cut or a less aggressive increase versus what the Fed is implying on its dot plots. Okay, so now moving to the Philippines, well, we are a beneficiary of the foreign fund flows to emerging markets. So right now, emerging markets are outperforming developed markets such as the US, and there are a lot of reasons why. First is the weak dollar. The weak dollar is good for emerging markets because that would mean higher dollar returns for foreign fund managers. Aside from that, we do have, emerging markets do have a relatively stronger fundamental. Okay, for example, we have the reopening of China, and China is one of the biggest components of the emerging markets index. Asia, for example, would be one of the key beneficiaries of the reopening of China because, of course, for example, the return of the Chinese tourists, the more robust trade that will happen with China. And aside from that, for example, countries like the Philippines, you know, are more domestically driven, so less sensitive to what's a potential slowdown in global economic growth. Aside from that, we have the underperformance and the cheaper valuations of emerging market stocks. I'll show you a table later as to how long and how bad the underperformance of EMs in the Philippines has been. And because of that, of course, the foreign investors have not been investing in emerging markets for the past 10 years. And yeah, aside from that, of course, people are excited about the reopening of China and what it means for emerging market stocks, and the expectations that the Chinese government would come out with more stimulus. Okay. So anyway, so as far as underperformance is concerned, you know, a lot of times we hear investors saying, you know, we've been investing in the Philippines for a very long time, but we have not generated a lot of returns. That was because in the past, you know, all the funds have been focused on the US. So the story of the Philippines not performing very well the past 10 years is the same story in emerging markets because, you know, funds were predominantly focused on the US, as you can see here in this chart. So the past 10 years, if you had invested in emerging markets, you probably would not have made money. And the story is similar to the Philippines. And because of that, well, stocks in the Philippines are so cheap. So if we look at the PE ratio of the different index members, we can see that almost all of them, I mean, for example, our index is trading at more than one standard deviation below the mean. And the members are also trading at a PE ratio that is more than 1. A lot of them are trading at PE ratios that are below the mean, with some even trading at 2 times below the mean. No? In terms of standard deviation, their PE is really very low. Okay. And, this is something quite interesting. So if foreign investors were buying Philippine stocks up to, consistently up to 2013, 2014. But since then, you can see that they have been consistently selling their positions in Philippine stocks. So much so that they have sold everything. If you just do a straight addition of all the buys and then all the sells. So right now they are negative, they're in a negative position. Okay, so whatever little they had, before 2010, they already sold it, no? So negative na. So super heavily underweight in Philippine stocks. But that said, I just like to highlight some risk to the market's strong performance because, I think these are very probable risks that should be, that you should take note of. First is the risk that the Fed does not cut rates. Okay. So I think what the market is pricing in right now is that, so inflation is under control and the Fed was able to do this, without really hurting the economy. So with the job done, they would be happy to just cut rates. But then there is a possibility that the Fed will not cut rates because if you think about it, the central banks actually would always want to be in a position to maintain rates at a higher level because this would give them ammunition just in case an economy enters into a recession so that they can actually cut rates. In their minds, if an economy can do well even with high rates, they would maintain rates at a higher level. So that is the risk. Since the market is already anticipating a rate cut, what if the Fed does not cut rates because the economy is doing well anyway? The second risk is that the bear market in the US continues. Okay, so right now, it seems like the US market is, bottoming out. Okay, and it looks like the bear market that happened last year is going to be a short and shallow bear market. Okay, but what if investors are wrong? And what if the US economy does suffer from a hard landing because the Fed continues to raise rates? And of course, we know that rate hikes work with a lag. And finally, by the second half of 2023, we see a hard landing of the US economy, not the 0.5% that investors are anticipating. Aside from that, US stocks are not cheap. They are still expensive at this point, trading at, at the historical average PE. The question I ask myself all the time, and which I don't know yet at this point, is can emerging market stocks decouple? Yes, our fundamentals are better than the US. Our stocks are cheaper. We're less vulnerable to, what happens there. The problem is, I recall 2008. No, during that time, the Philippines had better fundamentals compared to the US. We did not have the subprime crisis, etc. But when the US fell, the Philippine stock market also went down. So I'm not sure this time around if the US does suffer from a recession and a continuous bear market, if we can decouple and continue to go up even with the US market going down. And finally, locally, there are some risks to the economy. Because first of all, our inflation is still elevated and this could hurt consumer spending. So I'll show you more later. And if inflation stays elevated, the higher interest rates could hurt investment spending growth. And finally, government spending, which has during the past few years helped drive a rapid economic growth, may not be there anymore. So first of all, I'd like to show you the inflation rate in the Philippines. So, inflation rate in the Philippines has not yet peaked, unfortunately, notwithstanding the peaking of inflation in the US and the peaking of commodity prices. For example, the transport inflation you can see here has clearly peaked. This is the gray line. It has gone up sharply and peaked. Okay, but then again, our inflation has not gone down because food prices continue to go up. Okay, and it's not because food prices internationally have not gone down. For me, this just means that there are some problems locally. It might be a local factor that is causing the inflation problem, similar to what happened in 2018. And, if you look back at 2018, the market wasn't really very strong because of the inflation problem. And the high level of inflation also, makes it more difficult to justify the BSP cutting interest rates. Okay, so that is one of the risks that we have for this year. Next would be the government's limited fiscal space. So let's first look at the deficit to GDP. Prior to the pandemic, our deficit level was around 3% of GDP. And with our debt level of around 40% of GDP, a 3% deficit to GDP was something that the government could cope with, the country could cope with. They could continue to reduce the amount of debt. So we were able to maintain our investment credit rating status. But because of the pandemic, of course, taxes went down. And of course, the government had to spend more on ayudas to help people, struggling businesses. Of course, the deficit went up substantially. And because of that, since the deficit increased, the government had to fund it some way. So as you can see, the debt level of the government has gone up. And although the deficit is trending lower now, finally, the problem is, of course, the debt level is already very high. Okay, and will only go down slowly. And for the government to pay this debt level, the only thing it can do, of course, is to cut back on spending. So this is the 2023 government budget. So as you can see, the finance expenses went up sharply by 13.5%. The total number is up 4.9. So you think, 4.9 is not so bad, right? But the thing is, a big chunk of the increase will go to the financial expenses. Okay, so capital outlays, which means infrastructure spending, among others, will be flattish on a year-on-year basis. Personal services, this is the salary standardization. So it's more of the salaries of the people in government. But, in terms of social services, for example, the MOOE is actually down by 2.1%. So that would have an impact on GDP growth. Okay, consumer spending, yeah, maybe it's still going to be okay. But, every bit of help we can get is good. And for 2023, maybe even 24, 25, we can't expect the government really to, help a lot in terms of growth, because of course it has to deal with the high level of debt to GDP and, pay it down so that we will be able to maintain our investment grade rating. Okay, so that said, I'm now talking about my recommended strategy for investing in stocks. Although I have a positive view, I'd like to recommend a more conservative approach in investing in the stock market rather than an aggressive view. So one of the things that I think would be good is to have some cash or keep some dry powder, okay? And then, when stocks go up and become expensive, I think it's a good time to it would be a good idea to lock in some gains and then to wait for pullbacks before buying them. Focus on value rather than, just chasing growth. I think would be a good strategy. because of course, conditions are very risky, highly, so we expect the market to be very volatile. So it's better to stick to stocks that are still trading at good valuations rather than to buy expensive stocks expecting them to continue going up. No? And then, of course, aside from that, let's focus first on the large cap issues, the index issues that are more liquid. Because of course we're still in early stages, and most likely these are the stocks that will see the attention first. So let's focus on those stocks, and they're more liquid. So if we want to sell them, they're easier to sell. So speaking of the recommended portfolio, well, if you read around, what is the a standard portfolio or the recommended portfolio? I mean, usually they would say, oh, have an allocation of 60% stocks and 40% bonds. So when I say keep some dry powder, we want to have some cash, I would recommend a 40% bond, 40% stock, and 20% cash portfolio. So that, why have cash? Well, so that when the market becomes volatile, and if the negative risks do materialize, you have money to deploy and buy stocks at much cheaper levels. Okay. Okay, so these are my stock picks. So these stocks, in my opinion, are already good to buy right now. Okay, because for example, we have their buy below prices, and we feel that these stocks are still cheap and there are reasonable upsides. So you might ask, like, what are my favorite sectors? I also like the banks and consumer stocks, similar to what I said 6 months ago. But that said, I think that we cannot dismiss, for example, the property sector, which is less in favor right now, because they are simply too cheap. And my feeling is, once banks and consumer stocks become expensive, there will be a rotation towards the cheaper sectors, which are, also recovering anyway. So, which is why we are also recommending Ayala Land and RLC. Ayala Land, of course, is the biggest and most diversified property company. And Robinson's Land, the reason why we like them is, first, of course, the announcement was already out that RLC will be removed from the PSEI index. So that creates an opportunity to buy RLC at a cheaper price. But as you can see, the stock is really very cheap. It's trading below book value, and notwithstanding the fact that property prices are going up. And secondly, it has a huge mall portfolio, making it more resilient to the challenges facing the residential and office sectors right now. And these are other stocks that I like, except that, of course, their prices have gone up already. Okay. For example, URC, SM, and BDO. I think the more controversial pick that I have here would be PLDT, which was sold down significantly because of the budget overrun issue. People thought that there was fraud. The reason why I like it is something that I will be explaining later, because we will have a speed round where PLDT is one of the companies that are part of it. So with that, I'd like to end my presentation on the fundamental outlook of the stock market, and later